What's up, everyone? It's been a while, but now I'm back with more backtested strategies and actionable tips. This time we're going to be talking about Bitcoin, a really popular market of late. I've been a Bitcoin investor for some time now, through the futures and spot ETFs, but I've never tried trading Bitcoin due to its high transaction costs. To be clear, I'm talking about Bitcoin CFDs, not Bitcoin trading on one of the many exchanges. This means you don't have to worry about getting Bitcoin wallets, and won't run the risk of getting hacked, but you'll have to navigate some high transaction costs. These costs vary widely between brokers, but typically, you will see spreads between $20 to $60. Some brokers also charge 0.1 to 0.2% commissions, which may seem small, but assuming a Bitcoin price of $60,000, that's a whopping $60 per lot, 10 times more than what is typically charged for Forex. Swap is another killer in crypto CFDs. At minus 10% per day, that's about $17 per day, and there's even triple swap Friday. Pay attention to these costs when selecting your broker. I'm using Fusion Markets here, which charges about $20 spread and no commissions. Swaps are still nasty, but this strategy won't be holding positions overnight, so we're good. Although crypto trades 24/7, not all brokers allow weekend trading. In general, there are three possibilities. You could have the markets open 24/7 without restrictions, or 24/7 but new positions cannot be opened over the weekend, or 24/5 with weekends completely closed. Fusion allows weekend trading, as you can see, while others don't. The Fusion sign-up link is in the description if you're interested. As usual, I'm going to leverage StrategyQuant's genetic algorithm to generate the strategy, so some setup is required. I'll be trading on the 15-minute time frame, so under trading options, I'm going to set the daily close at 23:45 hours, so I don't pay those crazy swaps. In addition, I don't fancy the low volatility over the weekends, so I will prevent the opening of trades between Friday 23:45 and Sunday 23:45 hours. I would prefer a Monday open time of midnight, but we don't have that option here. Data will be the maximum available from Decascopy, which is 7 years from May 2017 to June 2024. I will input a spread of 2,000, corresponding to $20 since I define 1 pip as 1 cent. I'll split the in and out of sample portions evenly with this preset. Under performance filters, the minimum profit factor for both segments will be 1.5, with at least 250 trades required over the 7 years. Let's run the builder for an hour. And here's what it came up with. The mysterious QQE indicator rears its head again. I actually did a QQE strategy for the dollar-yen way back in 2022, which was my second video on this channel. The QQE consists of two lines, the smooth RSI line and the slow trailing line. Using its default parameters, you obtain the smooth RSI line by taking the 5-period EMA of the 14-period RSI. To get the slow trailing line, you obtain the absolute value of the bar-to-bar change in this smooth RSI and apply a 27-period EMA twice. Finally, multiply the result of step 4 by 4.236. This strategy only uses the smooth RSI line, or the value 1 line as StrategyQuant's pseudocode calls it. It instead uses a 62-period RSI, with the 5-period EMA smoothing unchanged. The 4.9 here is the multiple used for the slow trailing line, which isn't relevant for this strategy. Compared to the default QQE, this 62-period QQE is much smoother and removes most of the short-term fluctuations. So for longs, you want the smooth RSI, at the third most recent close, to be above 65, indicating bullish conditions. 65 isn't an extreme value for an indicator that's normalized within the 0-100 range, but the long 62-period look-back helps focus on more sustained trends. If this sole condition is met, a buy stop is placed at the second most recent low, valid for 10 bars. This condition actually looks for a short-term pullback. If the buy stop price is below the current price, the order is canceled and you get this message in your journal. That's why the order was only placed here, though the smooth RSI has been above 65 for a few bars. A 3.6 ATR stop is used, together with an 8.4 ATR profit target. Of course, we also have the 23:45-hour daily close, which was put to good use in this long example. Short conditions are symmetrical to reduce curve fitting, with the smooth RSI below 35, and the sell stop placed at the high instead. Here's an example. This short was lucky enough to hit the profit target, getting a 2.3 reward-to-risk ratio. I don't cherry-pick profitable trades, so here are the statistics from all 255 trades from the 7-year backtest. I used a fixed 0.1 lot size per trade. We just barely scraped through the minimum 250 trade requirement. The overall profit factor of 1.94 is great, but if we separate the backtest into the in and out of sample portions, we can see there's significant deterioration. Perhaps in a future video, I will run some robustness tests on this strategy to determine whether it's worth trading live. The payoff ratio is lower than the 2.3 mentioned earlier, since most trades were closed at the end of the day, before the ambitious profit target was hit. With the list of trades, you can determine the exit distribution by filtering the close type. On the Trade Analysis tab, you can see that profits were much greater on the long side, which seems to be a recurring theme among crypto strategies. Crypto investors tend to be in a bullish frenzy whenever good news is released, and with markets being relatively inefficient, strong rallies are not uncommon. The recent approval of spot Bitcoin ETFs is a good example of this. Finally, I decided to redo the backtest with tick data. This QQE strategy was generated using selected timeframe precision, meaning each bar is only modeled using its OHLC prices. I was actually surprised at how similar the backtests were. In general, you should not expect huge deterioration between your OHLC and tick backtests, unless you have very tight stops or profit targets, in which case the backtest engine may not know which price got triggered first. I'm actually incubating this very strategy on a demo account now, and if it performs well over a few months, I will likely trade it live. I will probably post an update video in a few months. To learn more about the genetic algorithm that automatically created this strategy, check the video at the top. If you're interested in trading gold with adaptive moving averages, check the video at the bottom.